Okay, we'll now continue with problem 5-2A on page 256 and 257. We'll pick back up with the fifth. Sold merchandise for $30,000 plus 6% sales tax to retail customers who use MasterCard. Remember, we'll treat those MasterCard sales as cash, or any credit card sales as cash. Cost of merchandise sold was $19,400. So we'll debit cash for the amount of cash received. To get the amount of cash received, we're going to take the sales price, $30,000, and multiply times 1 point the tax rate. So 1.06 in this case. And that'll give us the amount of cash received. That increases the asset account. We'll credit sales to increase the revenue account by the amount of the actual sale, which was $30,000. And then we'll credit the liability account sales tax payable to increase its balance for the difference, $1,800. But let's calculate it out. It's going to be equal to $30,000 times 0.06. Uh-oh. There we go, $1,800 either way. So it's a good way to check it. Add these two, should come back to your debit. Now we also have to record our reduction in inventory and the increase in our expense account. Remember, expenses increase on the debit side, so we'll debit cost of merchandise sold for $19,400. And we're going to credit the asset account merchandise inventory to decrease its balance by the cost of what we sold. Okay. Now we'll go to the 12th. I'll receive check for amount due from Equinox Company for the sale on the 2nd. Okay, look back to the 2nd. Equinox Company, we made a sale to them for $18,900. And on the 2nd, let's see, we offered it says 1/10, so we offered them a 1% discount. Okay, when they pay us on the 12th, we're not going to have more cash. All right? So we're going to debit cash for the amount received. But you guys, that's going to be equal to the sales price, $18,900. Minus the sales price times the amount of the discount, 0.01. So it's going to be the sales price minus the sales price times the discount. So that's $18,711. Let's look at that again. Okay, what we did here, you guys, I took the sales price, and from that sales price of $18,900, I'm going to subtract the discount. The discount, I screwed up my formula here. How about an old undo? Okay, we're going to take the sales price, $18,900, and then we're going to subtract from that the discount, which is $18,900 times 0.01. That gets us the amount of cash received. Okay, sales we granted a discount on a sale, so this time we'll use our new contra revenue account. Sales discounts increased for the year because we just granted a sales discount. It's going to be equal to our sales price, $18,900 from back on the 2nd, times 0.01, the amount of the discount, which is $189. And now what needs to come off the books? Well, they've paid us, so we need to take the accounts receivable that we put on the books back on the 2nd. Accounts receivable, Equinox Company was debited for $18,900. They've now settled that debt, so it comes off the books as a credit, $18,900. Remember, assets decrease on the credit side. So we're going to credit accounts receivable, Equinox Company, for $18,900, which should be the total of these two. If you add 89 to 711, that gets you 18,800 plus 100, 18,900. Remember, every journal entry, our debit side and credit side have to equal. Now on the 12th, it only requires this one journal entry, right? Because cash is coming in from a sale we made in the past. Inventory and cost of merchandise sold are not affected. They were affected back on the 2nd. Let's go through this one again, though. We debited cash for the amount received, which is equal to $18,000 minus $18,000 times 0.01, which is the discount. It's $18,711. Our debit to the asset cash increases its balance. We debited sales discounts for $18,900 times 0.01, which is our discount. And then we credited accounts receivable for the full $18,900, the same amount it went on the books at, back up here. Okay, let's keep moving. On the 14th, sold merchandise to customers who used American Express cards, $13,700. Cost of merchandise sold was $83.50. Remember, we'll treat those as cash sales, so we'll debit cash on the 14th for $13,700. We're going to credit sales, the revenue account, to increase its balance by $13,700. So, and then we will record the reduction in inventory and the increase in our new expense account, cost of merchandise sold. We'll increase it with a debit for $83.50. We're going to credit merchandise inventory for the same amount, $83.50. All right, let's keep moving. On the 16th, sold merchandise to Target Company, $27,500. Terms FOB shipping point, meaning the buyer pays transportation charges. We offered them a 1% discount to pay within 10 days. Otherwise, the full amount's due in 30 days. Cost of merchandise sold was $16,000. Okay, first let's record the sale itself. If we made a sale to Target Company on account, then the accounts receivable balance for Target Company increased. It's an asset, and they increase on the debit side, $27,500. Our revenue earned for the year has now increased. Remember, revenues increase on the credit side, and our new revenue account is sales. Then we'll also record the increase in cost of merchandise sold, our new expense account, by $16,000. And the reduction in inventory, remember, assets decrease on the credit side, for that same amount. Okay, now on the 18th, issued a credit memo for $4,800 to Target Company for merchandise returned from the sale on the 16th. The cost of the merchandise returned was $2,900. Okay, you guys, we made this sale to Target Company on the 16th, but they returned a portion of that inventory to us. Okay, so just like when we make a sale, we have to make two entries, one at the sales price and one at cost. If we accept a return on a previous sale, we'll have to make two entries, one at the sales price of what was returned and one at the cost of what was returned. Okay, first, at the sales price of what was returned, you would think maybe just flip this entry that put the sale on the books. You might think just do the reverse, and that would record the return. And you'd be partially correct. If Target Company returned part of what they purchased from us on account, then their accounts receivable balance decreased, by that amount, $4,800. Remember, accounts receivable is an asset, and they decrease on the credit side. Okay, but instead of debiting sales, we're going to leave sales on the books at the gross amount, and we're going to debit our new contra revenue account, sales returns and allowances, for the $4,800. That way, when we get to the income statement later in this chapter, we'll be able to show sales at the full gross amount for the year, and then returns and allowances separately. Okay, you guys, if they return some inventory to us, then we now have more merchandise inventory. It's an asset that increased by the cost of what was returned, which was $2,900. And our expense account, cost of merchandise sold, has now decreased for the year. Expenses decrease on the credit side. And notice that this entry, you guys, is the opposite of this entry. Okay. All right, we'll pick back up with the 19th in the next video. Thanks.